Welcome back to CEO Money. I'm Michael Yorba, your host. Thanks for joining us. All right. We've got Richard McCay, CEO, co-founder, Tieback Realty, on the show right now. Richard, welcome back.
Thank you for having me again.
My pleasure. All right. You've got, first, for those that new listeners have showed up, a little background on Tieback Realty, and let's tell me what's going on with you and Mike in a Pinpoint in Houston on your project.
Okay, so Tieback has been around for about 9 years. We have a development business in California. I only participate that in terms of financial advisory. I'm solely focused on what we're doing with Pinpoint in Houston, which is a venture to buy flooded homes and return them, well, not return them to their prior state of repair, but really improve them and bring them up to date for what buyers are looking for today in terms of color palettes and open floor plans, etc.
Let me jump in there and drill down a couple of details on this stuff. When you say buy homes, that's a big generic statement. Is there like a square footage size or a type that, because Mike said, and he was talking way over my head, well, we only do type A and so on. Can you break that down? What kind of homes?
We are not doing most, if we can't see a way to make 100,000, minimum 75, we target 100,000 profit per home. We try to move on to the next one because you got as much work on a $10,000 profit as you do a $100,000 profit. Really, it's not that much more work to get to $100,000 per. So we're looking at homes in Houston, which are really in the $400,000 to $750,000 price point when they're restored.
Okay.
And so that incidentally for this year has been the largest selling segment of the market. In Houston, anything over 750 is considered luxury. So this is just under luxury, it's sub-luxury, if you will.
Okay. So if you are, without giving away the secret sauce, but if you're selling the house for $400,000, you're probably able to pick up. Mike's running about 40% or so a year on his ROIs with this. You guys are picking them up, 30, 25, something, ballparking it like that? Because you got to have room for overhead, cost, and profit.
Well, I can give you the math on one that's the lower end of that spectrum. It was worth about $410 before it was flooded. We paid $185 for it. We're probably going to put $90 into it. Then there's other costs. We'll make about $65,000 on that house. That's if we assume no price increase. But there should be, because it's been another year and there's less supply in the market because there's 273,000 damaged homes according to FEMA.
There's an old statement in the trading business, and I'm sure it applies to your business too: money in, money out, time in the market. How long does it take to flip that or move that?
Well, typically flips. My history is that we had a fund that we managed with a public REIT as our source of capital. It was a revolve. We provided to the market, to this market, the first revolving credit facility to house flippers, and we only had 10 or 12 clients because we focused on larger ones who could use more money. And our largest borrower had $40 million revolving out with us. So we know a little bit about how to approach these things and underwrite them.
Mm-hmm.
So
but time in the market, how long do you think?
Well, I'm sorry, I got a little bit lost there. So we see typically everybody models to 6 months, but if you really get your tail moving, you can get out of them in 120 days.
Oh, that's like
you can if you really have your business organized, you can rehab these things in 2 months easily.
All right.
I say rehab. I don't want to say rehab because I think what we're doing is repositioning. You see a lot of bad products in the market where people are coming in, they're lowballing the construction budget. They're just, putting a coat of paint, changing out the carpet, fixing the drywall, it's really fix and repair and sell. So I don't like the term fix and flip. We like the term reposition and resell.
More accurate. I agree with you. It's more accurate.
Yeah, I think that's what we're doing because we're creating a lot of additional value. Now, in Houston, what's interesting, though, is that it's less about value creation, although there's an element of that there because the things that we're going to be doing different than others are doing in the market. But it's really value recovery.
Right.
It's not like you're searching for a future value. You know what the value was, and you know it's got to be higher because there's a lot less product in the market. Well, we're modeling everything to its prior value. We're not assuming any upticks, but the returns are, the IRRs are, over 50.
Now, I know you guys are not a mega trillion-dollar fund, so it's not like you're buying whole cities and repositioning the value on those.
No, but we're aspirational.
Okay, yeah, ditto. What do you think your penetration is in the Houston market, and where are you trying to get to with what you have available in your market sector down there?
Well, what we're trying to get to, because we just really started buying, this month, we have bought 4 and rejected 2 of the 6 we were looking at. So our plan calls for us to buy 4 per month, and then 9 and 13 and 19 and 19, and go up from there. With the capital we're requesting from Wall Street, which we're looking for $100 million debt and equity, we think we can turn in a 36-month period about 600 homes.
That's
but right now, we're still looking for funding, additional funding for what we call our co-invest fund for high net worth individuals, whereby they invest alongside the institutional equity.
Let me ask you an investment banking type of a question. What makes you and Mike and your teams feel that we're not headed for a sudden right-hand turn when it comes to value on real estate, all of a sudden a market pullback? What makes you say that there's still more room to grow, enough room to grow, that you can continue this model all the way out to the last numbers that you were mentioning?
Well, first off, you got a huge supply problem in Houston because of the flood.
Okay.
So that's going to support the market value there. But even when you look at the Houston economy, very diverse economy, a lot of what we call STEM jobs, science, technology, engineering and math jobs, and the cost of living index, which is produced by, I've forgotten the name of the people that, I hope they aren't listening, who produce this, but it measures your income, and it adjusts for the national average, and it comes up with an index to show how you rank in terms of cost, your income to cost of living. And number 1 in the country is San Jose. Number 2 is Houston. So that's essentially because the housing is so affordable.
Got it.
Compared to the job base. So there's been a 15% since 2000 net migration to Houston.
Richard, I know you got more to the end of that statement, but we've got to close. But I want to thank you for doing such a great job on today's show and answering those questions so succinctly. I know you guys are going to do 40, maybe even better as you go forward.
Thank you so much. I'm happy to come on anytime.
Thank you. Richard McCay, CEO, co-founder of Tieback Realty, sitting in for Mike Breeze of Pinpoint, one of our sponsors on the show. You've been listening to CEO Money with Michael Yorba. Thanks for joining. We'll talk to you again tomorrow.